Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have with us Conor Platt, co-founder and CEO and CIO of Etho Capital. We're taking a closer look at the world of socially conscious and sustainable investing funds, a topic that is really exploding in the fund world as of late. You're going to see a ton of funds in this space, and Conor breaks down some key points for those who are curious about this market. So if you have any questions or comments, make sure to send them in to podcast@zacks.com. And don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my chat with Conor right after this. Okay, Conor, thanks for joining us today to talk about a topic that is increasingly in focus for investors these days, and that is sustainable and socially conscious investing. First off, why do you think we have seen such a big surge in this type of investing lately?
I think the change in both millennials becoming a bigger part of the investment class, but also institutions, endowments, family foundations, NGOs, charitable foundations wanting their investments to match the values in which they're based on. And now we're seeing increasingly the use, and I think this is the important aspect, the use of sustainability data, sometimes referred to as ESG data, which stands for environmental, social, and governance, but the use of that data to find higher quality companies. And that's a lot of what we do at Etho.
So you think that millennials and younger investors are generally more interested in this type of concept? Do you have any idea why you think that might be the case?
It's certainly very, very strong indications both in the survey data and then the actions of their investment dollars. But also, importantly, pools of retirement money, municipal money, pension money, all of those things, those large pools of capital would like and have been pushing for the ability to invest their capital aligned with their values. And I think what you've seen over the last few years is the ability to do that and generate, importantly, the performance that they expect from their investments. And really that's been this just expansion of the data set to really be able to hone in on, we'll talk a bit more about this in terms of Etho, but, whether it be supply chain efficiency and governance, but really that whole integrating both sustainability and financial performance to create a better investment portfolio.
So when people talk about this concept, what kind of industries does this include? Or maybe perhaps a better way of phrasing it is, what kind of industries does this approach exclude?
Well, I think the first thing is it's important to, whatever approach you use, it's important to approach the entire universe before you do the exclusions to really look at the best of the bunch in each industry. And we do that through an efficiency lens. We look at a lot of data related to company supply chains and their emissions from those supply chains, both at the company level but at the supply chain level. We integrate that in with financial data like return on invested capital. Now, what we're doing there is really trying to say, before you exclude any company, what are the most efficient companies across all sectors and industries, and then using that as a starting point, then going deeper into the governance and stakeholder engagement and social awareness, the social scores, along with financials to find the best companies.
But there's some sectors that kind of get excluded pretty frequently, right?
The standard sort of sustainable investor is going to exclude, to one extent or another, the following sectors. Usually they're excluding alcohol, tobacco, and some people vary on their exclusions, but firearms, defense companies, traditional oil and gas companies, certain chemical companies, companies that have sullied their name in the press or with their reputation over short or long periods of time. A company like Monsanto is one that has a bunch of different controversies swirling around it and make it a company that's often excluded from sustainable investors' portfolios. But the number of companies excluded is a pretty fairly known level. and essentially there's still quite a bit of companies left to invest in, and that's really now become the new focus is, okay, so of what I have left to invest in, what both is a very strong company, whether it has a strong brand and great governance and strong fundamentals, or a growth company that is aligned with a lot of the mission of the values that the investor is putting forth. So whether it be a solar company of some kind. But it's all in the way that it's implemented as well. And I think that that's a big part of it, is that it's really this two-step process of you're using sustainability in the traditional financial metrics that all investors rely on, the accounting of return on equity, return on invested capital, and then implementing that portfolio in a usable form in the index that we created that the ETF is based on. It's a very broad-based, about 370-plus company exposure to the U.S. across market caps. And importantly, it's implemented in an equally weighted fashion once a year and then let the market take it from there. And we found that that is a really nice implementation methodology for sustainable investing.
Yeah, let's talk.
Provides both performance and the ability to really meet the sustainable objectives.
Yeah, let's talk a little bit more about your company's fund, the Etho Climate Leadership ETF, ticker symbol ETHO. Maybe you can talk a little bit about the sector bias relative to a S&P 500 fund. It sounds like energy is going to be a little low, but is there a boost in solar as somewhat of a replacement, or how does that work?
That's correct. So traditional energy is excluded in the Etho index. So that would be, currently, energy is defined as the integrated oils and then the energy exploration and then the suppliers. Doesn't include any solar yet. So currently we have a 0% energy exposure. The rest of the sectors and industries tend to be fairly in line. We have an overweight towards industrials where quite a few of the solar renewable plays sit in the electrical, and think GE as well, which has got a pretty large wind and solar and turbine business. Solar also sits in tech. It also sits in utilities, and we have exposure to all of those groups. We are slightly overweight utilities because utilities are just a small weighting in the traditional S&P. And we'll talk a bit about the S&P and sustainability in a minute. And essentially, it's light overweight in tech, but it's really pretty balanced. The equally weighted approach really allows for a very nice broad exposure without any dramatic tilts, with the exception of what we're not invested in, which would be the traditional energy space. And that's both a mission of the firm, but also really when we look at the equity investments picture in the traditional energy space, we don't find it particularly compelling as an overall group. There'll certainly be individual winners. There has to be. But overall, in the broad approach, it just doesn't seem like it's going to be a source of great equity growth going forward.
Yeah, we've seen a lot of, either pension funds or endowments kind of going towards this whole fossil-free trend. Do you think this is something that a lot more pension funds and other investors are going to pick up on in the coming years?
Depends how they approach it. I think increasingly pension funds and the larger groups are concerned about the stranded asset risk, which I guess for your viewers, what that means is that if you're Exxon and you own a ton of reserves and you think at some point in the future it's just not economically feasible because of, for whatever reason, to pull those reserves out of the ground so they become useless, and a good portion of your market cap currently is based on those reserves, and you see the same situation in Saudi Arabia, sort of highlights this to a T. If you ran Saudi Arabia 15 years ago, your incentive to pull oil out of the ground was there but not dramatic, because you probably rightfully thought, hey, this will be worth a lot more 5 to 10 years from now. And now you know that if the price gets too high, there's plenty of energy to be found with both technology and so it's sort of a race to the bottom. And that's what stranded asset risk is. So I think people are starting to think about it that way from an economic risk perspective, in addition to perhaps the climate considerations that they may or may not have. But the economic risk perspective is something that definitely wakes up investors. And so, yes, I think that it increases the likelihood that people take a low carbon or quote-unquote fossil-free approach. We do at Etho have companies like airlines. We happen to have the most efficient airlines. I mean, that's what we're trying to do, is say, as much as we can, have every company in the economy, because they serve a purpose. And many of the companies that have to deal, specifically airlines, and they're a pretty good example, companies that have to deal with fuel as a large input cost tend to be the most innovative in terms of their efficiency. And you've seen that in airplanes, both from a capacity utilization standpoint, which is not so wonderful for customers, but also all the material science and efficiency on the engines and planes themselves in terms of the materials used.
Yeah. So how do you find these climate leaders? Is this publicly available information, or do you have to kind of dig in a little more deep into financial statements and whatnot?
It's the usual mix of private, public, and your own work to normalize data to really look across lots of sectors and industries. So we use a series of data providers, but really then combine and normalize that data such that it actually can be usable. But what we're ultimately doing is really comparing companies within their own industry and against their global peers to see who is the most efficient per dollar invested, both at their supply chain and their company level in terms of their output. And that data comes in all different kinds of forms, including carbon footprinting. So you hear a lot about carbon footprinting of a portfolio, maybe from a Norwegian sovereign wealth fund as carbon footprint of its portfolio. Well, a lot of that data is quite usable for other things, and we use that data set along with others to really ferret out which companies are the most efficient in their operations. And then we take that data as sort of a way of saying, okay, how can we cut down this universe and take a much deeper dive, a more meaningful dive on the financials? How are they as a stakeholder? What are their employee policies? What is their governance? Governance is being how the board composition, how the companies run, what representation on the board are women and minorities, what are the tenures, how has the company done in a crisis, which is probably the most interesting thing. How do they deal with things that come up? Because every company, there's no perfect company. There's always going to be issues. How do they respond to those issues?
So in some ways, sustainability can be sort of a sustainability of the company itself. Is that fair to say?
Absolutely, yeah. And that's sort of the point, is that's why this is becoming an increased adoption one way or another. It's about looking at the sustainability of the company. The terminology in business speak would have been the moat around the business, right? We often use that kind of terminology, the moat around the economic drivers of the business. And sustainability is just another feature to that. Increasingly, a large portion of companies are intangible assets, correct? I mean, it's creating both some real opportunities, but also some havoc in the traditional accounting standards. But the intangible assets and reputational ability of companies and brands, if you will, is really, really important. And sustainability is one of the things that's really touching upon that, but it's also that it's a bit ephemeral, right? That doesn't take long for that reputation to get impugned. So it's important for there to be really strong governance, really strong stakeholder engagement, really strong views towards the environment, or at least limiting one's impact, right?
Yeah, and it seems like some of these items might be sort of nebulous in terms of like a strong view towards the environment or strong governance policies. How do you decide what is good enough for the fund and what kind of is just not up to par?
Sure, we really drive off efficiency and then look for the outliers in the governance and stakeholder engagement. We also are looking at the outliers on the financials. It's not that you're ever taking one single variable in isolation. You are integrating all of them over time and really saying, okay, the first cut is saying who is the most efficient, and then the second cut is then saying, okay, of these efficient companies, how do they rank relative to their peers on governance, on stakeholder engagement, on financial performance? And it becomes pretty clear who the leaders and who the laggards are in that exercise. And if you just take even almost like a general like weighted average approach across those categories, you can clearly see. There are the places where we spend our time deciding what goes in and out are really, things on the margin of those variables, but also companies where some percentage of their revenues are coming from a activity or industry that we otherwise would be against, and whether that's a legacy position they're winding down or it's something they're trying to grow. And if it's something they're trying to grow, then we naturally take it out. We look at, we own utilities because you have to have power, and utilities really are one of the front lines of this adoption of renewable scaled energy. So increasingly, utility scale solar competes with every form of energy. Ask people in Nevada, ask Warren Buffett, he'll tell you. He's very happily owns quite a few solar developments. But so we own those companies, and some of those companies have nuclear in their power stack, and some of them have a bit of natural gas, and we'll own those companies as well. But we pay close attention to that power stack and how it's being generated and what they're tilting towards. And we're really kind of looking at how companies, and we really look at this, sustainability is yet another form of strategy in creating that moat around a business. The companies that are adopting sustainability, and that really encompasses both efficiency, governance, better stakeholder and shareholder engagement, so better environments for employees, in theory, should create better productivity. And when you really look at the companies that are adopting these sort of approaches, they tend to be the fast-growing, high-performance companies.
Sure. So how do you see the strategy fitting into an investor's portfolio?
Well, I think really our process is about finding high-quality companies, really at the end of the day, that happen to be in the most sustainable industries. So if you just put the sustainability side away and just say, these are high-quality companies, the way we're implementing them, and we're coming up on a rebalance actually in the next few weeks, but we basically invest in an equally weighted manner. So 370-plus companies means about 20 basis points a company, roughly. And what that really means is you have the broadest exposure to what we think are the most efficient, highest quality companies. And taking that broad multi-cap approach, we think it's core equity exposure. I mean, that's one of the issues in the sustainability space is sort of a twofold issue. There really hasn't been a good benchmark for investors to both achieve reasonable financial performance or keep up with the markets, but also some semblance of sustainability tilt, a real sustainability tilt. And we think our index is that. Previously what the goal has been is to take the S&P 500, take those 500 companies, try to get rid of 50 to 60 companies that would be not in line with most sustainable investors' guidelines, and then re-rate the remaining 440 in such a manner that it sort of looks like the S&P and hope that you get the S&P's performance. And most of the time people are disappointed with everything. And we knew that had been the path that a lot of people had gone, and that really that's what the opportunity was, that we had a better methodology, but also there was just this need and it, obviously remains an open question whether or not we'll ever become the benchmark. But we think we've made something that's pretty usable and straightforward, and its implementation in the ETF, equally weighting any index. So if you took the S&P 500 equally weighted versus the S&P market cap weighted, and users can do this at home, if the ETF is RSP for the equally weighted S&P 500, and then obviously SPY for the S&P 500. And if you look over 3 to 5 year periods, the equally weighted index wins. And it wins, generally speaking, because it's not overweight, overvalued companies, and it's generally a bit overweight, undervalued companies, just by the nature of its construction. And over longer periods of time, that leads to the outperformance. And we use that coupled with the fact that we know that in any given year, given a broad enough exposure, our company may not meet our standards, they may get indicted, and something may happen, and we need the ability to systematically remove them and not impact the rest of the portfolio exposure. So that's a long-winded answer, but we think we're a very solid core U.S. equity exposure. We have a international index in the works, and then other variations. Certainly a sustainable income portfolio is something that we are putting a lot of time into right now. And so that's really just combining a lot of the work that you've seen in dividend funds combined with the work we do at Etho.
Definitely. And, actually, just for the listeners out there, we just did a equal weight podcast a couple weeks ago. So make sure to check that out to see more what Conor was talking about in terms of why the equal weight strategy might be a better one. But Conor, best of luck with Etho. I think we'll have to leave it there for now. Thanks for coming on and take a look at what investors need to know in this sustainable and socially conscious investing world. Thanks for coming on.
Great. Hey, thank you very much. Have a good one.
All right, everyone. That was Conor Platt, co-founder, CEO, and CIO of Etho Capital. You can check out more information regarding his company's ETFs at ethoetf.com or more about the process on ethocapital.com. Well, hope you enjoyed this edition of the Dutra Report. Make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts in the ETF world, make sure to go on over to Zacks.com, check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find and review the Dutra Report on iTunes. And if there are any topics you want us to discuss, feel free to reach out at podcast@Zacks.com, my Twitter page @EricDutram, or leave us a comment on Facebook too. Be on the lookout for a new edition of the Dutra Report each and every Thursday. But until then, for Zacks.com, I'm Eric Dutram.